So I'm recording. So today we're going to do question 11.3, which is a statement of cash flows for a sole trader. Yesterday we did question 11.5, which was a statement of cash flows for a company. Then the last question that I'm going to do with you is on Monday. We're going to do another company statement of cash flows, question 11.8. Later on today, we'll put up a program about what we are planning to do for next week. But if you have any requests in terms of revision, you please need to let us know, send us an email. Please, I hope you have looked at the scope of the exam. So if there are questions and things you want us to look at, and specifically, you need to let us know. Okay, so let's look at question 11.3. So we have got J traders, and it has an owner. So immediately we see it's a sole trader. And we have the financial year ending 31st of December 2005. And they're giving us the following information. We're quite used to seeing this now. We see the statement of financial position at the year end date. So we have the closing balances for this year, the closing balances for last year, which are this year's opening balances. If we just quickly read the non-current assets, that's going to be the investing section of my statement of cash flows. We've got PPE and investments. Current assets is going to be the operating activities section, but remember bank we look at last because we balance the statement to the bank account. So under the operating activities section, we've got inventories and trade receivables and trade payables under current liabilities. Then under the equity and liability amount for equity and long-term loans are going to go on the financing section of the statement of cash flows. So it's a good idea when you get a question just to look at the statement of financial position, have a look at which accounts they're giving you, because that's going to affect what calculations you're going to need to do. Because I know often the question is, which ledger accounts do I need to do? This is already giving you an idea of the kind of ledger accounts you're going to need to do. Okay. If you have questions now, I think the best thing is to type them. If you want to answer each other's questions, please feel free. And then I'll also take questions at the end. All right. So have a look at what's on your statement of financial position, because it means you're going to probably need to do calculations for most of those items. Then the next page, they give us in this question a statement of changes in equity. So this is reconciling the capital balance at the beginning of the year to the capital balance at the end of the year. This additional contribution will be an amount we received from the owner that will go under the financing section. They've told us the profit for the year. So if we have to reconstruct, which I think we're going to have to do in this question because they don't give us the statement of profit and loss, and we have to reconstruct that to get our other expenses amount, they've at least given us the profit amount here that we can work with and then work up what the balancing amounts are for the amounts we don't have. Drawings we are going to be showing under the operating section of our statement of cash flows. These are amounts that the owner has taken out. And we have drawings because it's a sole trader. Then an extract from the note for property, plant and equipment. If we go back and look at the first page, we've just got one line for property, plant and equipment. So what they're doing now is they're giving us what the amount was for cost and what the amount was for accumulated depreciation at the end of this year and at the end of last year. Okay, then the items included in the profit for the period, they've given us sales, cost of sales, interest income and interest expense, and those items must be shown separately on the face of the statement of cash flows. Depreciation we're going to need to work out. That immediately tells you that here you're going to have to recreate general ledger accounts because that's the way you're going to work out this depreciation amount. And they tell us there was no sales of property, plant and equipment during the year, but there was new equipment. So we've got to look for how much we paid for the new equipment. And we'll also find that out by reconstructing the general ledger account for property, plant and equipment. So that's already given us an idea of the kind of calculations we're going to need to do. And we're preparing the statement of cash flows for the year ended 31st December 2005. So we're going to start with the operating activities section. So you've read your question, you've got an overview of what's there, you're already thinking about the kinds of calculations you're going to need to do. Remember what I've said is that in the exam, we probably won't ask you the whole statement. So then you need to be focusing on the section that we've asked you and what kind of information you're going to need to calculate. Okay, so your first thing is to write a format. And as I've said, please make sure that you study the format, that you know the wording, the name of the business, statement of cash flows. It must say for the year ended. You start with cash flows from operating activities, leave about half a page, then put cash flows from investing activities, leave a couple of lines, cash flows from financing activities, leave a couple of lines, and then you'll reconcile at the bottom to either the increase or the decrease in cash. So if there's an inflow, it will be positive. If there's an outflow, a decrease in cash, it will be in a bracket. And then we start with the cash and cash equivalents at the beginning of the year. We add the increase or decrease in cash for the year, and that will give us the amount we have in the bank account and the cash amount at the end of the year. So you get your format down based on what the required was in the question. In this question, under the operating activities, you always start with cash received from clients and cash paid to suppliers and employees, and the difference is the cash generated from operations. We saw in the question that there was interest received and interest paid, and those amounts we actually already can get straight from the question. So we put them in and you start scoring some marks. Drawings by the owner also was given to us in the statement of changes in equity, so we can put that in. Please notice the payment and the drawings by the owner are outflows of cash. Remember, if this was a company, we wouldn't have drawings, we would have dividends, and we would be looking for taxation paid as well if it was a company. But because it's a sole trader, we don't have dividends and we don't have taxation paid. We're always going to probably need to do a calculation for cash received from clients and cash paid to suppliers and employees. So I've written my calculation numbers here because I know I'm going to need to do calculations for those. So the first step is I've got my format down. I've got detail for what I want to do under operating activities. I've put my operating activities amounts in that I already got from the question. Okay, so the debtors. This is fairly simple. In the question, they gave us the opening balance of debtors is 9,000 and the closing balance of debtors is 8,000. In the question, they told us the sales amount. So remember, the journal entry is you debit debtors and credit sales, 560,000, which means the balancing amount here is 561,000. That's the amount of money you received from your customers. The journal entry would have been debit bank, credit debtors. Remember, the shortcut way of getting that is by taking the 560,000 and looking at the difference between your debtors at the beginning of the year and your debtors at the end of the year. So 9 minus 8 gives you a difference of 1,000. Refilwe, do you want to ask a question? Or was that a mistake? Okay, so look, your debtors decreased by 1,000 from the beginning to the end of the year. We say that that decrease basically means they paid us an additional 1,000 Rand. So that's why we take the 560,000 and you add 1,000 and you get 561,000. Okay, so that's the amount of money we receive from our customers. We reconstruct the debtors account to get that amount. And we put that into our statement of cash flows, cash received from clients. Okay, Refilwe, that's fine. Okay, so now we've got to work out cash paid to suppliers and employees. Now in this one, the reason we're doing inventory and creditors is because the information they've given us the opening and closing balance for inventory and the opening and closing balance from creditors. They've also told us what cost of sales is. So in the question, this number is given to you. But we don't know this number, and we need that in order to be able to calculate how much we paid to our suppliers. So we use the inventory account to calculate that number. So in the inventory account, the credit side adds up to 330. We subtract the opening balance of 8. That means we bought inventory on credit for 322,000 during this year. So the journal entry was debit inventory, credit creditors. So it means we owe the creditors 322,000 plus the 8,000 the beginning of the year, we owed them 330. The end of the year, we only had 4 remaining that we still had to pay, which means we paid the creditors 326,000. You just need to check carefully the information given to you, but for inventory and creditors, you normally have to do both to end up working out how much you paid to your suppliers. Remember, that's only the first part of your cash payment to suppliers calculation, because you've also got to go and look for your other expenses that were paid during the year, including amounts paid to staff or salaries. So that will be a second calculation that you have to do. So the 326,000, I've put it here already so that I don't forget, and I'm going to add to that my other expenses. In the question, if they don't give you an SPL, I do suggest that you reconstruct it, and what you're going to then do is you're going to work out what your balancing amounts are. I'm just going to show you. So in your SPL, the sales and the cost of sales they've given us, which means you can work out gross profit. Sales minus cost of sales gives gross profit. They've given us interest received in the question, and they've given us interest paid. And remember the net profit amount they've given us as well, because that came from the statement of changes in equity. So that amount we have. So this amount of 207,500 is basically a balancing amount. You need to just work it out yourself. But if you take 240,000 plus 2,500 and you subtract 3,000 and you subtract the profit of 32,000, you're going to get 207,500. Okay, that should actually be in a bracket, sorry. So that 207,500 is the balancing amount. So if you now had to take 240,000 plus 2,500, subtract 207,500, subtract 3,000, you will get 32,000. Okay, so this was a balancing amount, this other expenses. So we needed to know that, because the amount we're looking for is what were our cash expenses for the year, and other expenses will include depreciation, but we don't know the depreciation. So we're going to need to go and calculate the depreciation, which means we're going to have to go and reconstruct our property, plant and equipment accounts. So those are investing activities, property, plant and equipment, but we have to go and do it now to get the depreciation amount so that we can subtract it from the other expenses to get the cash expenses for that second line under operating activities, cash paid to suppliers and employees. So our next step is to go to the property, plant and equipment accounts. So they don't specify what type of PPE, everything is in one account. So here's your opening and your closing balance at cost. Remember, this is the cost. And then the accumulated depreciation, they give us the opening and the closing balance. They've told us that nothing was sold during the year. So that makes life very easy, which means the difference between the opening and closing accumulated depreciation is your depreciation amount of 6,000. So if you go back to your statement of profit and loss, you now put that 6,000 in, okay? I'll come back to the equipment amount now. I just want to finish the statement of profit and loss. So this accumulated depreciation was the difference between your closing balance minus your opening balance. It was depreciation for the year. So the entry would have been debit depreciation, credit accumulated depreciation. While we're here, let's just look the difference between the opening and the closing balance for PPE is your additions of PPE for the year. We know they tell us in the question that new equipment was purchased for expansion purposes. So this is going to go as additions under the investing section of your statement of cash flows. Okay, so let's go back here. So you've got the 207,500. Clinton, remember, with before and after tax, this is a sole trader. So sole traders don't pay tax through the business. They pay tax privately. So it's only when we have a company that we have to worry about tax. And then if you're aware, the sales we receive, it's the money we're receiving from customers that we are interested in. So if sales are on credit, we always need to go and reconstruct the debtors account, because the debtors account we need to put together to find out how much money we receive from the customers. So in the debtors account, we will have a credit where we've got the amount of money that we've received from the customers. It will be credit, debtors, debit, bank. So unless sales are cash sales, we always have to do the debtors control account. So if there are credit sales, you must do the debtors control account. And when you see debtors in the statement of financial position, it means also that there obviously are sales on credit, and you must do the debtors control account. Okay. So going back to this reconstruction of the SPL, this then, the cash expenses is your balancing amount. Your other expenses were 207,500. 6,000 is depreciation, so 201,500 are expenses that were cash expenses. So if we now go back to our statement of cash flows, this was the cash paid to suppliers, and this was the cash paid for other expenses, including salaries and wages. So that will give me the 527,500. Okay. We had cash receipts from clients of 561,000. Cash paid to suppliers and employees, 527,500. That means our business generated 33,500 rands worth of cash. We already had the interest received, interest paid, and drawings amounts. So we're just going to add the interest received to the cash generated, subtract interest paid, subtract drawings, and we end up with 4,000 Rand cash being generated, cash inflow from operating activities. Okay. So you will see, if you were a user, this is quite interesting information to read, because it's telling us something quite different to what the statement of profit and loss is. It's telling us that this business generated 33,500 Rand cash from its operations. But if we take into account interest and the drawings the owner took out, there was only 4,000 Rand cash left from operating activities. Then the cash flows from investing activities, this additions amount, if you remember, I got from reconstructing the equipment account here. It's the difference between the opening and the closing balance for PPE. And remember, on your statement of cash flows, you need to separate between whether it's additions or replacements. There was nothing sold during the year. They told us this is for expansion purposes. So that's why you call it additions. Okay, so we've got quite a lot of the cash flow statement completed already. We do need to remember that on the face of our statement of financial position, if we're looking now at step 2, investing activities, we also had investments. So we've done the PPE. We saw there was equipment that we bought during the year. If we look at investments, the balance went down from 30 to 25. Okay, so that means 5,000 must have been recovered from selling the investment during the year. 5,000 was received because your asset reduced. This asset normally has a debit. Assets always have a debit balance. When assets decrease, it means they're credited, and the debit would have been a cash inflow. So this decrease in the financial asset represents an inflow of money. If the financial asset increased, it means we've spent more money, and that would be an outflow of cash. But because it decreases, it means we've recovered money. It's an inflow of cash. So under the investing activities section, we showed the additions with a bracket and the proceeds from the sale of investments without a bracket, which means investing activities, we spent a balance of 10,000 Rand. Okay, so that's the investing activities section. Now, if we finish by going to look at financing activities, the equity between the beginning and the end of the year, we can see what made up the difference between the beginning and the end of the year in this question, because they gave us the statement of changes in equity. So that tells us, and we'll go and look at that just to check what, if any, cash amounts there were, accounting for the difference between the opening and closing balance. With the long-term loan, The balance was 30 and it's now 20, which means we've repaid 10,000, which would be an outflow of cash. If this amount had gone up, it means we would have borrowed more money, which would have been an inflow of money for the business. But when it goes down, it means we've repaid some of the money we owed, which is an outflow. If you go and look at your statement of changes in equity, the only cash amount that we've got here that we need to account for now, financing activities, the amount of money that the owner put in. Drawings we already accounted for separately, and the profit for the year we've excluded the non-cash flow items and we've worked out cash generated from operations. So we've done that calculation. So it's the 5,000 Rand, which is going to go under financing activities. This is the amount of money the owner put into the business during the year. So the owner's increased his capital contribution, which is an inflow for the business, and the loan was repaid by 10,000 Rand. It reduced by 10,000 compared to last year, which means the cash flows from financing activities is a negative amount, an outflow of 5,000. So to finish off, we just need to balance to our bank account. We had 12,000 in the bank at the beginning of the year and 1,000 at the end of the year. So if we go to the last section of our cash flow statement, we first take 4,000, subtract 10,000 and subtract 5,000. That gives you 11,000, which is a decrease in cash for the year. Okay? And that 11,000, if we subtract that from our opening balance of 12, it balances then to the amount of cash that we have remaining at the end of the year. And that's the end of that cash flow statement for a sole trader. Fairly simple, quite similar to the example we did yesterday, but I actually think it's quite a lot easier. If I just think about Monday, on Monday I'm going to do a big question on question 11.8, and on Monday I'm going to try to make it that you actually work with me a lot more. So for Monday, I would encourage you to join the class. We're going to be doing another companies. It will be our last cash flow question. And I am going to require you to be thinking a little bit more with me as we do the question. But that will be our last question. Okay. Going back to this, questions. I'll give you a few minutes to just think if there's something you didn't understand. Otherwise, if you're okay, I'm done for the day. Everyone happy? Can you give me a happy face if you're fine? Enjoy your weekend, guys. You have got some studying to do. Exams are just around the corner. Okay. So sorry, the holiday is coming after that, but now you need to do some work. I'll see you on Monday. Thank you.